Welcome to the Real Estate Forum, a podcast from the Paul Milstein Center for Real Estate at Columbia Business School. I'm your host, Raphael Sidelsky. This is your place for key insights into the evolving real estate landscape, from candid conversations with real estate thought leaders, including the esteemed faculty of the MBA Real Estate Program, to cutting-edge research from the Milstein Center's Research Lab. Let's dive in. My guest for this podcast is Ron Dickerman, the president and founder of Madison International Realty, a global private equity real estate firm and one of the world's leading liquidity providers to real estate investors. Madison operates from offices in New York, Los Angeles, London, Luxembourg, Amsterdam, Frankfurt, Singapore, and Seoul. The firm specializes in acquiring interests in indirect or illiquid ownership structures, including limited partnerships, limited liability companies, open and closed-end funds, private REITs, and joint venture or co-investment interest. Since Ron founded the firm in 2002, Madison has raised over $8 billion in capital commitments and invested across the US, UK, and Europe. He's a graduate of Columbia Business School and Tufts University. Ron, welcome to the show.
Thank you so much, Raphael. Thrilled to be here and to be able to chat with you.
Ron, your father was in the real estate business. Tell us about your early exposure to the industry.
He was indeed, and he was quite a role model for me. My father was in the real estate business in the Boston area. When I was a little kid, I remember going to look at apartment buildings on the weekends to figure out what his next acquisition was going to be. It was the old-fashioned real estate business, but it created a window for me on a business which I thought was fascinating. It was tangible, it was real, and it was something that I could understand as a very young person, and perhaps really set the stage for me to think about having a career in real estate.
Okay. Well, let's fast forward because it's really fascinating how Madison got started. You were at Smith Barney, where you were originating real estate limited partnerships, and that experience led you to launching your own firm with a focus on secondary market transactions. That was a space few people were paying attention to at the time. Walk us through that time period and the genesis of Madison.
Maybe coming from my father's example as an entrepreneur and the lifestyle that he led, it was always my objective to figure out a way to start my own business. I was also aware that that business plan needed to be unique and something that I thought had a reasonably good chance of succeeding, and that was differentiated. And my story is one of really not knowing where life is going to lead you. I did have the advantage of knowing that real estate was something I was interested in. So actually, after my time at Columbia Business School, where I was a real estate concentrator, I threw in a resume and got a job offer at Smith Barney, which is now part of Citigroup, in their real estate investment banking department. And I thought I was going to show up and finance big, tall office buildings in the sky. And much to my surprise, I was explained that I was going into a new department called direct investments. And I was going to originate real estate limited partnerships and sell the LP interest to high net worth clients of the firm. This was a long time ago. I'm going to date myself now, 1987 to about 1991. But it was very similar to the business today of BREIT, what Blackstone is selling in the context of private REITs and open-ended funds. It just existed a long time ago. So I did that for 5 years, and I got very expert at analyzing real estate for acquisition, packaging real estate into limited partnership formats, understanding waterfalls, understanding how to market LP interests, and selling them through the retail brokerage network. And that was a big business on Wall Street during the time that I indicated, probably $50 billion of high net worth investor capital from doctors, dentists, and lawyers that flowed into these real estate limited partnerships. The issue is that they were illiquid. There was no quote unquote secondary market or a way for those investors to monetize the value of their interest. And thinking about the timing now, this was the mid 1990s when I started Madison and developed this business plan. And what was becoming interesting was dot-coms, Microsoft and Cisco, And even investors like Warren Buffett, the great Warren Buffett, thought that he had lost a step and didn't really understand technology. And his view was, maybe I don't understand this .com thing, but I know it's not for me. But other investors were interested in selling their limited partnership interests in real estate and buying into the new economy. And I started Madison on the basis that there was an opportunity to provide liquidity to these LPs. And since I knew how to value real estate, knew how to understand a waterfall and what the net asset value was likely to be, we came up with the concept of figuring out the value of the underlying real estate and buying the LP interest at a discount. And that was the beginning of Madison. We did several prototype transactions. It turned out that investors were quite interested in finding liquidity, and Madison was born.
So, but those early years were full of uncertainty. What led you to be steadfast and stick with providing the secondary liquidity to investors and make, what convinced you that this would be an enduring business model?
Perhaps it was the early traction we were getting that investors were seeking us out and were taking advantage of the liquidity offers that we were making. So I would say it was the early success in some of the prototype transactions and just a recognition that the real estate business was growing. It was becoming a global asset class and becoming more of a sophisticated professional investment niche of a diversified investment portfolio. When I started trying to follow my father around at some of the apartment buildings I mentioned before, real estate was a bootstrap business, very unsophisticated. But I would say from the time that followed, my time at Smith Barney and in the early stages of Madison, new firms were growing up. The Carlyle Group, Starwood, Blackstone, Brookfield. These were highly sophisticated professional organizations that were forming investment partnerships and using other people's money. But nobody was putting any effort or to figure out how investors could gain a liquidity mechanism or event when they changed their mind and didn't want to own in an illiquid vehicle for 8 to 10 years. So it was becoming more and more obvious that we were fulfilling a needed niche of the commercial real estate business, which was growing from hundreds of billions to potentially trillions. And Madison became one of the first movers, in liquidity solutions in secondary market transactions in commercial real estate. And I can tell you more about this, but we were successful in globalizing the business, as this phenomenon gained traction.
Well, yes, I look forward to discussing all of that. And you've increased your aperture to include a broad range of secondary entry points, well beyond just limited partnership interests. Tell us about some of those and why investors continue to see early exits, even in all these newfangled vehicles.
Yeah. And frankly, it's a direct reflection of the plethora of investment opportunities across sectors that investors have today, both institutional investors and high net worth retail investors. So it is true, our business was very fundamental in the early days. We were focusing on what we call LP-led transactions, where individual limited partners decided to step out of these illiquid vehicles and looking to redeploy their capital into other opportunities, and we're seeking out Madison as a facilitator. Today, we're doing many other things like GP-led transactions and continuation vehicles. We'll talk more about current market fundamentals, but given the dearth of capital in the marketplace, given the environment, given the rising interest rates, rising cap rates, and so much capital sitting on the sidelines, many investors had not received distributions on legacy real estate investments that they've made over time. And we're being approached more and more by general partners themselves who are looking to form what they call GP-led transactions or continuation vehicles. We've also been very active in the public markets, where we've actually provided private capital to public companies where their shares are trading at discounts and they're looking to raise money in a creative way instead of issuing shares where it may not be efficient for them to do so. We've also scaled our business across geographies. So you mentioned at the beginning the offices that we have around the world. We also invest not only in the United States, but in the UK and Europe. We actually have opened offices in Asia, and we hope that's the leading edge of opening up more investing activity in Asia itself. So the real estate business has become global, and so has it Madison.
Ron, you've acquired interest in some of the world's most iconic buildings, the Seagram Building in New York, the Lloyd's Building in London, the Trianon Tower in Frankfurt. Tell us about these deals, how they came about, what made them compelling, and any lessons you've learned from being part of these landmark assets.
Yeah. And one of the things that I think our listeners will find interesting is so many buildings that you walk by every day and you look in the lobby and you see the nameplate and it says, in this case, RFR Realty, or Morgan Stanley or Tishman Speyer Properties, or names that you would have heard of in the real estate business. But what you don't realize is that so many of these buildings are owned in joint ventures, joint ownership structures, club deals, syndications, co-investments, private REITs. These are all examples of exactly that issue. So the Seagram Building was perhaps one of the most interesting and first transactions that we did with what I'll call a world-class iconic asset. And we've known RFR Realty for almost 2 decades, think very, very highly of them. And one day, about 3 years after the original acquisition of Seagram by RFR, we got a phone call from one of the 2 principals who said, we have an original $10 million limited partner that called us and wants an exit. Is this something that Madison can help us with? And we said, as a matter of fact, that's exactly our business. So we underwrote the building. It didn't take us long to figure out that the rents had almost doubled in the building since acquisition. And the investor was simply looking for a return of their original capital. And we knew that the NAV of the building was substantially higher than that. So we underwrote the building, we communicated a price, we spoke about RFR's business plan, and we ended up buying the interest in that building for probably a 10% uplift versus the investor's original cost, when we thought that the value of the interest could be substantially higher. We also knew that RFR was planning a recapitalization of the building at some future point in time, and that would likely represent our exit strategy. So it was the first transaction that we did in a what I'll call a flagship or a Class A world-class asset. It went full cycle, and we harvested a very handsome IRR. And sort of the business of Madison went through an inflection point, given the high-profile nature of that asset. Lloyd's of London Insurance Building, people know Lloyd's of London. It's 1 Lime Street. It looks like a spaceship. It's in the city of London, and it was actually owned by a German syndication. It was a 30-year triple net lease to Lloyd's. Lloyd's at the time was a AAA credit. And we worked with a German general partner who approached us on the idea that many of the underlying German investors, the LPs, Germans call them closed-end funds, were interested in liquefying their position. And we conducted a tender offer through the German general partner and bought up a significant number of the underlying shares. And sure enough, the building was sold about 5 years later, and that created a capital event for us. And then the Trianon was another interesting story. The Trianon is an iconic office building on Mainzer Landstrasse in Frankfurt. For those of you that have been to Frankfurt, it's directly down the street from the Deutsche Bank world headquarters. They call them the Twin Towers. And it was actually a joint venture between 2 Morgan Stanley open-ended funds. This was just after the global financial crisis. One of the funds was healthy and operating well. The other one had become somewhat distressed and was looking to sell their 50% interest. So Morgan Stanley approached us. We ended up buying a 50% interest in the building in joint venture with the other Morgan Stanley fund. We went through some very successful leasing cycles, and the building was ultimately sold to a Korean investment group, and ultimately sold to Colony Capital thereafter. So our view is that was another example of how we globalized our business, New York, London, Frankfurt, and really put Madison on the map as a global liquidity solutions provider, all from a different subset of underlying investors.
A different type of signature investment for Madison was the Forest City retail portfolio, Atlantic Terminal, Atlantic Center in Brooklyn, along with 42nd Street properties near Times Square. How did that transaction come about, and why was it such a strategic pivot for Madison?
So another example of what I'll call sort of a GP-led transaction where we created a liquidity solution for a public company, which at the time was Forest City Enterprises. So most everybody knows downtown Brooklyn. They know Atlantic Avenue. They also know Barclays Center, which is the home of the Brooklyn Nets, the professional basketball team. And at the time that we found this opportunity, Barclays Center was a hole in the ground. And I mentioned our listed property business providing private capital to public companies. So we're very in tune with property-heavy public companies like REITs and real estate operating businesses that may need capital from time to time. And it just so happens that we were listening to a public earnings call that was going on from Forest City Enterprises. People knew that they had made a very bold step, which is they had bought the New Jersey Nets basketball team. They warehoused it on their own balance sheet. They announced a condemnation and an RFP, another very bold business, which was building Barclays Center in the middle of downtown Brooklyn. And as we were listening to this earnings call, we knew that the company was under some pressure, that it had gone through the global financial crisis. The stock price was not performing adequately, and they were looking for a creative way to raise money. And in response to a Wall Street analyst question on the earnings call, who said, "How are you going to finance Barclays Center? It's a $500 million development, and it's difficult for you to raise money today." And they said, "Well, we own 2.3 million square feet of retail, including the assets that you mentioned, Raphael, the Madame Tussauds Wax Museum in Times Square on 42nd Street, Atlantic Center and Atlantic Terminal, which is on Atlantic Avenue in downtown Brooklyn. And we're going to go out and find a joint venture partner. We're going to sell down a 50% interest, and we're going to use those proceeds to build Barclays." So that was our aha moment, as they say. We called Forest City. We said, "Come on over to our office in New York. Let's talk about creating a customized liquidity solution for you to see if we can help you accomplish your objective." So long story made short, we wrote them a $200 million equity check. We bought a 50% interest in their New York City retail portfolio. And our view was this was a very different type of retail. It was entertainment-oriented, transit-oriented. Everybody knows about Times Square. It's probably the largest tourist attraction in the United States by people. Also, Atlantic Center and Atlantic Terminal get its name because it's directly over the intersection of the Long Island Railroad and the New York City transit system. It's the third most heavily trafficked subway stop after Times Square and Grand Central Station, not to mention the fact that Barclays Center was in the process of being built. So we maintained a great partnership with Forest City for about 5 years. We were thrilled to have front row seats at Barclays Center when it opened to watch the Brooklyn Nets play basketball. We also knew that the portfolio itself was under-rented versus the market, even though the tenancy looked like a tenancy from yesteryear. The sales per square foot were extremely high because of the population densities. So even today, the portfolio proceeds to do quite well on a sales per square foot basis. And the transaction did take an interesting pivot, which was prior to the time that Forest City was bought by Brookfield. They were going through a bit of a strategic planning process, and their view is they're in too many businesses. They were in office, residential, retail, and a little bit of industrial. And their view was retail was the odd sector out. So they approached us and said, "We're interested in exiting the retail business." And we said, "Well, that's very well timed because we're interested in buying the rest of the portfolio we don't already own." So Madison actually conducted a second step follow-on transaction where we literally bought the rest of the portfolio, the other 50%. And now we own the entirety of it. We've done some trimming, we've done some re-tenanting, We tried to move the portfolio into, the sort of the next generation of cool kid tenants in retail, and we've been successful in doing that. So another inflection point, a customized liquidity solution for a public company, which I believe was somewhat high profile. At the time, it made us the third largest retail landlord in the 5 boroughs of Manhattan.
Great example. And you mentioned earlier, we talked about the fact that you began in New York and now you span 3 continents. What was the actual turning point that allowed you to scale internationally? And how has this global footprint changed the way you source and manage investments?
It's a great question. The answer is it really was a necessity out of our underlying counterparties and customers who were seeking liquidity. We had very positive results with many of our counterparties in the early stages of Madison. But one of the things that became more and more clear is some of these counterparties were approaching us and said, we just did business with you, in our investments involving the Seagram Building or the Lloyd's of London Insurance Building as examples. But we also own interest in buildings in other parts of the world. And is that something that you can help us with? And it became very clear that we needed to be in the yes business instead of no, thank you, I wish we could. So we began to open our offices internationally. We began to hire people on the ground. Everybody knows that real estate is a local business. What goes on that street corner is idiosyncratic and specific to underlying real estate assets. So we knew that we needed to be experts in these local markets, and that's how we rolled out the geographic expansion. It happened slowly. It took us a year or maybe 2 when we entered a certain market to feel comfortable about making go-forward investment decisions in those local markets. But over the course of time, we spread our wings, we opened other geographies, and I think that cross-pollination had to do with the exponential growth of Madison that we began to experience.
You've also started providing strategic growth capital to middle market operating platforms. How do those partnerships differ from your traditional recapitalizations?
Yeah. So exactly the same phenomenon I just described in terms of the geographic expansion has also happened with regard to product line extensions. So up until the moment or the question you just asked me, this brought us to about 3 or 4 years ago, Madison was providing liquidity solutions for specific properties and portfolios to investors globally. Many of the counterparties that approached us knew Madison's business. They knew that we specialized in liquidity solutions for legacy investors. But upon questioning, we became very focused on the idea that what they really wanted and they really needed, in addition to liquidity solutions, was go-forward growth capital to fuel the acquisition machine. That's the lifeblood of what we do in the real estate business, capital to fuel acquisitions. So again, we thought, wouldn't it be a good business proposition for us to be in the yes business? So we began to socialize this with some of our large investors, and we said, what would it take? What type of a business execution plan would be required for us to be able to lead with liquidity solutions, but also provide growth capital to these mid-sized investment management businesses that were approaching Madison for that purpose? And we came up with an idea, which is what we really would want would be alignment, that we're happy to provide the capital, which I mentioned before, but we also want to buy a minority stake in OpCo or in the platform itself, where we could share in asset management fees and carried interest that these investment managers earn on capital they manage for third parties. So we started a new product line that we call Madison Growth Platforms. We received a sizable allocation from a sovereign wealth fund that's been an investor with us for many, many years. We've hired a team of people to execute, and effectively what we do is write $100 million checks to mid-sized investment management businesses looking to grow, where somewhere between 2/3 to 3/4 of the capital can go into the property side of their business. We want proven management teams with a good track record in the right sectors where $100 million will move the needle. And somewhere between 25 to as much as 1/3 of the capital, we want to go to buy a minority stake in OpCo or in their platform itself, where we can align interests, and we can share, like I said, in asset management fees and carried interest. And Madison itself has been through several inflection points. We talked about many of them during the course of this call. And our hope is that we can also coach up many of these investment management businesses on exactly the same inflection points that we went through as we grew to a global multi-billion-dollar firm. So we think about capital introduction, finance and accounting, data analytics, DEI and ESG, things that are still very, very important to us. And we find that our counterparty companies are very receptive to hearing more about those opportunities.
You said that Madison's business tends to thrive when there's volatility. In today's environment, high interest rates, limited transactions, and tighter credit, where are you seeing the most attractive dislocations, and how are you positioning yourself for sector, geography, deployments now and in the future?
Yeah. I certainly wouldn't wish volatility and some of the challenges that we all face in the real estate industry, as a kind of a regular way phenomenon. But it's been a very difficult ride for real estate investors over the last 2 to 3 years. We've lived through an unprecedented period of time, starting with COVID, to vaccines, to the supply chain snapback, to inflation, to the Ukraine and oil prices, monetary policy intervention. Then you deal with the Trump election, the Trump trade. It's been a lot. And the impact on the real estate business has been volatility for sure, and a lot of capital sitting on the sidelines. And our view is you probably have to go back to the global financial crisis to figure out a time when there was such a dearth of liquidity in the marketplace. And it would follow that being a liquidity solutions provider would be a popular place to be in periods like this. So what we're finding is more investors are approaching us for a liquidity need in lieu of an underlying sale of the properties or distributions that they expected to receive on their legacy capital allocations. And we're also finding that both LPs, GPs, and other counterparties, many of which we've talked about already, are willing to transact with us at what I'll call larger discounts, given the bid-ask spreads. We're also finding that primary market activity is somewhat muted, that no rational investor would sell their properties willingly into the marketplace today based on high interest rates and the basis that most people expect interest rates to fall over the next 6 to 12 months. So if that's true, why would a rational actor sell their property today? But there might be an underlying need for liquidity by an investor because of unforeseen capital needs, or maybe just the opportunity cost of capital. Everybody knows what's going on with artificial intelligence and the Magnificent Seven. Investors may have a view that, I can make more money investing in the stock market in AI than I can in real estate. So I want to monetize the value of my real estate investment and invest it someplace else. So these are all examples of what drives Madison's business, and this is a very fertile time for us.
You said that real estate isn't just about sticks and bricks, it's also about people. How does that philosophy influence Madison's culture and your approach to partnerships?
It really shines all the way through that one of the things that we love about real estate as an industry is exactly the phenomenon that you just described. And anybody with experience in real estate knows that this is a people business. No matter what phase of the business you're in, from architecture to design to construction to acquisitions to leasing to finance to marketing, it all revolves around people. And I think that comes back to sort of the globalization of real estate as an asset class. And I think that served us extremely well. One of the things that we love about our business model is at the very essence, we're in the marriage-making business. We create partnerships. The traditional real estate business is about buyers and sellers. And somebody wants to buy, somebody wants to sell. And maybe you get along well at the closing table. Maybe you don't. Maybe the elbows are a bit sharp. Maybe you like each other. Maybe you see each other again. Maybe you won't. The way it works in Madison's world is, tell us now, because we're going to be partners for the next 5 or 7 years. We're effectively making a marriage. And that's why partnerships and people have become so important to us.
Are there any particular sectors or parts of the world that you find most interesting at the moment?
Yes. I would say both. One of the things that's really driving our business today is the intersection of real estate and technology. That the other thing that we're starting to see is human beings changing their behavioral patterns and how they live, work, play around commercial real estate assets. And at the end of the day, we're trying to make an investment method, which I'll call real estate secondaries, with a real estate investment opportunity investing in physical assets. So, to give you some examples, we're very focused on living strategies, on industrial strategies, on data centers. Everybody knows what's happening on their iPhone and the use of data. Data centers have been about a third of our investment activity over our recent fund cycles, and they've been performing extremely well. We've also been focused on industrial, but I think people know that Class A industrial warehouses are overbuilt and leasing has run out of gas. Like Amazon isn't leasing a lot of new space in Class A bomber warehouses. So we've been very focused on cold storage facilities. And I know, for example, in my own household, my wife used to insist on going to the grocery store to buy the raspberries. She was the best person at picking out raspberries. Now she picks up her iPad, she presses a button, and we have raspberries on our front door in about 2.5 hours. That doesn't happen by magic. It happens because of the facilitation of cold storage facilities in the food chain. The other thing that we're seeing within the living strategies is multifamily has been the belle of the ball for 10 years. The truth is multifamily is going through a period of oversupply, muted rental growth, and very unlikely that we're going to see cap rate compression. We're also seeing negative leverage in the industry. But we're very enamored with single family homes for rent. We've bought 10,000 single family homes over the last 2 or 3 years. And the reason is we view the single family home business to be dramatically undersupplied in the United States, probably by about 4 million units. We also think that the millennials are finally getting married and having children. And many of them are renters by choice, not by necessity. Their dream is not like their parents' dream of owning a home. They don't want to sell their NVIDIA stock or their Bitcoin to put a down payment on a house. So our play on single family reflects human beings and their behavioral patterns. So we think it's a fascinating time to be investing in real estate, fascinating time to think about artificial intelligence and the convergence between technology and physical assets. And that's where we're trying to live.
Great. You've spoken about your goal of joining the small group of real estate firms with double-digit vintages. Tell us about the next chapter at Madison.
We're very invested in the next generation. I love coming to work every day and working with young, smart people who are so much more savvy than I am as it relates to technology and where the world is moving. Madison, we hope, is a perpetual business. The idea of liquidity solutions is not going away. There are perhaps a few more competitors today than there were when we first started our business, but it's a very underexposed niche of the commercial real estate markets. We're starting to see a convergence also between real estate and infrastructure. One of the questions I get a lot when I talk about data centers or cold storage is people say, wait a minute, isn't that infrastructure? And my view is, well, I think it's real estate, but I'm happy to have a debate with you about it. It's a very healthy discussion. So it may be that maybe the future of Madison, is a move into the infrastructure business. There's many other things, but at the end of the day, we're staying super busy as a liquidity solutions provider for real estate investors globally.
Ron, how did your MBA and how has your continued involvement at Columbia Business School influenced your business activities and network over the years?
It's interesting. I loved my time at Columbia Business School. I can't say that I remember, everything I learned in every academic class and every textbook. But what I did remember was the experience, sort of it opening doors for me. The people that I met have gone on to become, senior executives and entrepreneurs and have become movers and shakers, within industry generally. And I consider it to be a terrific resource. Over the years, I've come back and taught case studies for Madison at Columbia, which has been terrific. And I get stopped up by people at the business school or in business, and they say, I attended one of your case studies. One of them was actually on the Seagram Building, and the other was on the Trianon office tower. So I love hearing those stories, and I would encourage anyone thinking about business school to seek it out. And I think Columbia Business School has only gotten better and better. been up to the new campus on 125th Street, and it's spectacular. And I just had a terrific experience there.
Before we wrap up, I'd like to ask for a personal recommendation, something outside of real estate, a book, a habit, a trip, or something that's important to you from a life perspective that guides you or has guided you.
Maybe consistent with some of the things we've talked about so far today is I really urge anyone in whatever business they're in to be a global citizen, to travel, to get on airplanes, to push themselves, to go to regions of the world that they may not otherwise see or feel comfortable with. One of the hallmarks of Madison is I've traveled all over the world. I circumnavigate the globe 2, 3, 4 times a year. I'm going to Seoul on Sunday morning. I'm recently back from the Middle East. I've been traveling in both the Arab part of the Middle East and Israel for 15 years. And I've seen the evolution, and I love talking to people on the ground about geopolitics and what they see. One of the things I'll tell you is the situation on the ground is always different from what you read in the newspaper or what you see on the news. And I remember going to London for the Brexit vote. I remember being in the back of a taxi cab and listening to the cabbies. The Brexit vote was 2 days away. It was June of 2016. And I remember the cabbies being mad as heck. They didn't want to take it anymore. And I met with some CEOs of public and private real estate companies, and their view is, I don't think Brexit's a risk. And I remember being in Riyadh, Saudi Arabia, when oil prices were $28 a barrel. And it's just so important to see the world through their eyes. I also think this may sound trite, but in some ways, investing is the great equalizer. Doesn't matter what language you speak, doesn't matter where you live, doesn't matter what your religion is. Everybody wants the same things: great relationships with people they trust, where they can make investments and have a reasonably good chance of earning credible rates of return. And that's what keeps me going. I really love it. So again, I would urge everybody listening to this to be a global citizen, go on an airplane, be a representative of the United States and or whatever country they happen to reside in, and they'll be rewarded for the relationships that they create.
Excellent. Well, Ron, thank you so much for joining us on the Real Estate Forum. We look forward to seeing how you and Madison continue to shape liquidity and partnerships in global real estate.
Thanks so much for doing this, Raphael. I'd love to come back and be your guest again. And thank you so much for the very insightful questions.
Thank you. Thank you for listening to the Real Estate Forum, a podcast brought to you by the Paul Milstein Center for Real Estate at Columbia Business School. Be sure to subscribe for more insights from real estate thought leaders, industry professionals, faculty, and the latest research and expertise from the Milstein Center's Research Lab at Columbia Business School. If you've enjoyed the episode, please follow, rate, and share the podcast. You can keep up to date with the Paul Milstein Center for Real Estate at business.columbia.edu/real estate. Thanks again for joining us, and we will see you next time.